Until a few months ago, securing a bank loan was relatively easy, to the extent that at one time, banks were literally hawking loans targeting salaried employees. But this appears to have changed after the central bank undertook to limit the amount of money in circulation in a bid to tame rising inflation by using such tools as its lender of last resort, the central bank rate, which has since been increased to 6.25%, as well as the overnight discount window, which has risen from 8 to 20% in less than 2 months. Commercial banks have now restructured their loans to cover the added cost build-up items, cater for rising inflation, and protect their profit margins.
What will happen is that interbank rates usually are a benchmark for lending to customers and to corporations. So if interbank rates are rising, and as of Friday they're at least 19%, then you're likely to see higher rates for banks, and for customers and for companies.
The net effect, loans have become more expensive and more borrowers are likely to start defaulting on their monthly payments. Although analysts agree that the regulator is justified in its attempts to rein in rogue banks, the impact of actions taken will mostly be felt by borrowers. For instance, a customer taking a loan of 1 million shillings payable over 5 years at an interest rate of 16% will pay 459,000 shillings in accumulated interest. But the same loan, payable over the same period at 17% interest, will attract an extra 32,000 shillings in interest payment, bringing the total interest payable to 491,000 shillings, almost 500,000 shillings above the principal amount borrowed. The saying cheap is expensive could soon become more true than it ever was for many Kenyan borrowers, with rising interest rates making loans so expensive that even those in banking are advising potential borrowers to think twice before taking that loan.
In an environment where interest rates are rising, I think you're better off saving for your purchases, or at least postponing a lot of your purchases.
Though the high rates are a reflection of some form of market correction in an industry where the cost of loanable funds was previously on the lower side, analysts believe the rates will come down soon. But this will depend on whether or not the current trends will help ease the inflationary pressure on the economy. Wanjiru Gaitho, Citizen Business.